Welcome, I'm Wes Lindquist, Chief Accounting Guru at Precision Financial LLC. Precision Financial exists to add best practices, guidance, and oversight to the existing bookkeeping of small businesses. This video is to communicate the top 5 ways bookkeepers steal from companies and what to do to reduce the risk of embezzlement. The frequency of fraud in the United States is shocking. I've been the CFO for over 60 companies, and just when I think I've seen it all, I learned of another story of fraud. Just recently, I heard a story of an $8 million a year revenue company where they caught their previous bookkeeper stealing, and prior to that, they had 2 bookkeepers working there at the same time, and both of them were caught stealing. It's quite startling. Fraud can get quite elaborate, but most fraud can be deterred and detected with some basic time-tested practices. Knowing how fraud commonly occurs drives strategy of how to prevent it. Any good bookkeeper knows how to commit fraud at your company. In an environment where they perceive the likelihood to get caught is higher, the fraud needs to be more complex and the person's motivation to steal needs to be higher. Without further ado, here are the top 5 ways bookkeepers steal from small businesses. Number 5, stealing cash. The top ways to steal cash are 1. In businesses that deal with a lot of cash, like retail stores or businesses with cash registers, or 2. Businesses that have petty cash. Petty cash is eliminated in most well-run businesses. I strongly suggest doing away with petty cash. Employees can fill out expense reports and get reimbursed. If you do have petty cash, have a person who oversees accounting sign off on the reconciliation of it monthly, checking for receipts and documentation for every purchase. When you have a cash register, it may not be the bookkeeper who steals, but there's still ample opportunity for undetected theft. If you have a business with a cash register and you can change to credit card only, that's ideal. If you do accept cash, put a security camera over your cash registers to deter and detect theft. Require management approval for all credits or voids. Number 4, paying unauthorized amounts through payroll. In a lot of small businesses, the bookkeeper runs payroll and approves payroll. Any employee can fill out an overstated timesheet, including a bookkeeper, and a bookkeeper can pay a friend more than their time card says by modifying the hours, rate, or overtime. To control this, payroll for all employees should be approved by the managers of those employees, including the bookkeeper's time. It should be standard practice that someone else reviews every payroll report. Knowing that someone else is paying attention to the payroll report is a significant deterrent to committing payroll fraud. Also, note a common place for theft is by failing to record vacation time used, which overstates the employee's vacation balance and overstates the payout that the employee gets when they leave. Method number 3 of bookkeeper fraud is releasing unauthorized payments, usually forging checks. Most importantly, never give your bookkeeper security rights to move money electronically or check signing authority. If someone does forge a check or release an unauthorized payment, it's going to show up in the bank statement. So always require that the person who reconciles the bank account be separate from the person who prints checks. Someone else should open the bank statements when they arrive and look for unusual transactions. Method number 2, charging unauthorized expenses on the company credit card. Even if your bookkeeper doesn't have his or her own credit card, they probably have access to the number. Most commonly, in terms of fraud, credit cards are used to purchase personal items, personal meals, gas for personal vehicles, inexpensive personal items. If that goes unnoticed, the next level is something like taking your family out for a nice dinner and putting it on the card, or buying more expensive items or gift cards. When the credit card statement arrives, the business owner or a qualified manager should review the statement. If anything looks unusual, investigate. There should be a different card for every person who might use a card, even if you keep them all under lock and key. This increases accountability and reduces time to figure out which transactions were charged by which employees. Set the tone in your company that receipts are required for every credit card transaction. The number 1 method of fraud committed by bookkeepers is passing off checks to fictitious vendors, especially in situations where the bookkeeper doesn't have authorization to disperse funds. Usually the fictitious vendors are for a company created by the bookkeeper. Dollar amounts are typically low enough that someone reading the income statement wouldn't notice. If the bookkeeper does this well, there's a fairly small recurring charge that goes out to the vendor to create consistency. It isn't unusual for fictitious invoices to be created. The best practice to control this: checks are only to be printed for invoices that are approved for payment by someone other than accounting. Accounting's role is to process transactions approved by others, not to approve transactions. When the check signer signs checks, the invoice should be paperclipped to it, and the approval should be paperclipped to it. At Precision Financial, we want business owners to understand how to use good financial information to maximize success in business. We want bookkeepers to understand and use best practices, and we want to see embezzlement in small business eliminated in our lifetime. Check out our website, precisionfinancialllc.com, to learn more about how we help small business.